Hi guys, I welcome you in this wonderful video. So today I'm going to be speaking about the method that I use to increase my profits, which is scaling in. So I'm going to share with you how to scale in your trade so that you get maximum returns from every position that you open. So let's say here you decide to just execute a buying trade here after this minor breakout. Let's say you enter a buy. So one thing that we have to avoid as a trader, which I've spoken about in previous videos, make sure that you avoid opening multiple position at the first entry. Don't open 2, don't open 5 position at the first entry, but only open one position. Let's say you decide to buy, open one position with your risk management in place, meaning you're using the right lot size and you position your stop loss at the right place. Now, after you open that position, if you are trading, let's say you are opening this trend in a trending market, this trade in a trending market, you have to make sure that your target is not limited to the wave, meaning you are not entering here to exit there, or you are not entering here to exit there, but make sure that you are entering here to exit only when the market is reversing. Meaning when you're trading in a trend, the advantage or the benefits of trend trading comes from the ability to ride the trend until it reverses. If we are opening here, closing here, opening here, closing here, it's not that beneficial, although you might get the profits that you need. However, they will not be compared to the guy who will just open it once and then close it when it starts to reverse. And also it trains you to actually be bold and be patient. So I hope that is making sense. If you are trading in a trend, make sure that you practice holding your trend for a while. And then how are you going to increase your profits as the trend continues? Let us just get into it. So one thing that you have to note as a trader is that when you open your position, you don't open a position and then get away from the screen. You open your position, and as the market proceeds, or as the market keeps on moving upwards, you have to reanalyze your chart. You have to reanalyze your opportunities and try to find other opportunities as the market proceeds or as the market continues to move. So we can see now that the market is entering in a corrective, going all the way down, and then it kind of give us something like a breakout. So we can see that it entered in a quite a long corrective. We can indicate it by channel. We can see that it entered in a corrective. After you've entered here, it's an impulsive, and then now it's a corrective. And after the corrective, there is now a breakout that came here. There's now a breakout that came, and then from this breakout, if you were starting afresh, that's where you're gonna enter your trade. But now, because you are not starting afresh, this is where you're gonna scale in your trade, meaning you have your position here, which is the first position, and then this is where you're gonna say your initial position plus 1, meaning that's where you're gonna execute the next buy again, meaning now you'll be having 2 positions running. What's the advantage of this? The advantage of this is that when you open this second position, this second buying position, it is no longer going to take from your account if you lose, because now your stop loss is no longer only there, but you now have your stop loss somewhere around here, meaning both your trades, your stop loss is here, meaning if this trade doesn't work, you're not gonna lose anything from your account because you are not risking from your account. But if the market starts to collapse and closes here, your second trade is risking the profits from the first one, meaning you're not gonna be taking from your account, but you're gonna be taking from your first initial trade. That's the advantage of this. So when you open here, and with your stop losses there, you again wait for a next opportunity, or you again reanalyze the market as it is moving up and wait for corrective waves again to re-enter. Or if the market is showing you some signs of reversal, that's where you're gonna be exiting your trades. So let's see, there it was a next corrective wave, and then it was broken through this huge impulsive there, through this huge candle, and then that's where maybe you're going to be executing your next trade. But remember, this is just an example, guys. In some cases it can be hard to find these entries, more especially this one, and I usually don't encourage traders to follow up when the market is giving them a huge candle. For an example, in this one, it might be hard to get this huge candle because it just happened in one single move or in one single candle. But in all the other example, it was quite easy to find those opportunities. Even if you don't find this opportunity, at least it's an advantage, because you already have two positions which are opened, which are running. Even if you don't find this next entry, it's still on your profit, still growing on your side, and maybe you're gonna find the next entry that comes in. But the point of this, it is to make sure that when you enter your trade, you analyze as the market continues to move. As the market proceeds, you analyze and re-enter, meaning you don't open these two positions at the initial entry, but you wait for another opportunity to come, you add in, or you scale in your trade. You wait for another opportunity to come, you add the third position. And the good thing, as I said earlier here, that you are no longer risking from your account, but you are risking from the trade that you have opened initial, or from the initial profits. And then when it comes to exiting your trades, you have to wait for signs of a reversal. What are signs of a reversal? Obviously, when the market gives you lows which are lower than the previous, and highs which are lower than the previous one as well. So when the market begins to give you lower highs and lower lows, that's when you're gonna be looking forward to exiting your trade. So overall, you will close with huge returns. Why? Because you've been scaling in as the market proceeds. And one last point that I'm going to point out here, I'm just going to make an example, a quick example here. So let's say the market keeps on moving up, and then it start to slow down, like this. So it started aggressively at its early stages with the huge waves, and then it started to slow down. You observe that the waves, they're becoming a little bit smaller, meaning the impulsive wave, they're becoming a little bit smaller, and the corrective waves, they're becoming a little bit bigger. Then you know that this is now the right time to scale out. What is scaling out? Scaling out is doing the exact opposite of what I was talking about here, meaning you start, let's say you had your initial position here was a buy, and next buy, the third buy. Then here, when you observe this is when you have to start cutting now. Maybe you have to start cutting your first trade, you close it, and then as it proceeds, if you see that okay, now it is indeed starting to reverse, you cut the next trade, or you cut the last two just all at once, because you can see that now it's giving you a high which is lower than the previous one. So this is how, guys, you should maximize your profit, or this is how you should increase your profits. This is the method that I use, just scaling in, and then when you observe that okay, now a reversal is likely to come, that's when you have to start scaling out, and then overall you will have a lot of returns without risking anything in your account. The only trade that is risking your account, it is the initial trade or the initial position that you've opened first. I hope this is making sense. So let me just keep it short and leave it here. Thank you guys for watching this video.